Right now, there are there are trillions of dollars moving completely invisibly through the global economy.
Yeah, trillions. It's staggering.
And this money is aggressively dictating, which tech platforms survive, which breakthrough medicines actually make it to clinical trials,
Right.
even which legacy retail chains quietly go bankrupt and just vanish from your local mall.
Exactly.
But if you try to track this capital, you won't find it on the New York Stock Exchange. You won't see it ticking across the bottom of a financial news network.
No, because it operates entirely off market. I mean, we are talking about a financial ecosystem that is deliberately structured to function behind closed doors.
Completely shielded.
Yeah, away from the intense regulatory glare and the daily volatility that public markets have to endure.
Welcome to the deep dive. Today, we are opening the door to that hidden engine room. We've got a massive stack of materials here, academic course slides, financial glossaries, expert interviews.
The heavy reading.
Right, the heavy reading.
Yeah.
And our mission today is to synthesize all of this for you. We are charting the complete, brutal, and highly lucrative life cycle of private equity and venture capital.
And the goal here isn't just to, define some vocabulary words.
No, we want to understand the actual mechanics.
Right. We're going to trace exactly how a private fund spots an opportunity, the really aggressive legal architecture they use to lock down control of a company.
Which is wild, by the way.
Oh, it's intense. And the financial engineering they deploy to multiply their returns, right up to the heavily orchestrated exit strategies they use to finally cash out.
Okay, let's unpack this. The umbrella term we always hear is private equity. But practically speaking, this isn't just one monolithic strategy, right?
Not at all. It functions almost like an entirely parallel universe to the public markets. And it serves a very specific dual purpose depending on who you are in the transaction.
Right.
You have to look at private equity as a transaction connecting two very different sets of anxieties.
Okay, I like that framing.
Yeah.
What's the first anxiety?
So on one side, you have a private company. Maybe it's a tech startup, or maybe it's a massive family-owned manufacturing plant.
Sure.
They desperately need capital, but they either cannot stomach the crippling interest rates of traditional bank debt.
Right, the monthly payments.
Exactly. Or they want to completely avoid the massive, expensive regulatory nightmare of an initial public offering.
An IPO.
Yeah. So to the company, private equity is a vital financing alternative.
Okay, and the other side of the table.
On the other side, you have the financial institution, the fund itself. To them, this is a high-stakes, highly illiquid investment.
Meaning they can't just sell it tomorrow.
Exactly. They are deploying capital into an asset they cannot easily sell. They are banking entirely on the idea that they can actively force that asset's value to multiply over time.
And we should clarify early on, because I feel like this constantly gets conflated in the media.
Yeah.
Venture capital is not a completely separate industry from private equity.
No, it's not.
Venture capital is simply one highly specialized, deeply risky subset, tucked firmly underneath that broader private equity umbrella.
Precisely. All venture capital is private equity, but not all private equity is venture capital.
Right.
And the defining characteristic that ties it all together, the phrase that really captures the whole ethos of this industry, is smart money.
Smart money. That's the critical distinction for you to keep in mind today. Because if a company just needs cash, a traditional bank is happy to provide, quote unquote, dumb money.
Dumb money.
You take out a commercial loan, and as long as you make your monthly interest payments, the bank really doesn't care if you pivot your product line or change your marketing strategy.
They don't want to sit in your board meetings.
Exactly. They're a purely passive debt provider. But private equity operates on the exact opposite philosophy.
Oh, completely. When a private equity fund buys into your company, they are buying a mandate to intervene.
They want the steering wheel.
They want the wheel, or at least a firm hand on it. Smart money implies that the investor is bringing deep sector expertise, a massive Rolodex of industry contacts, and a ruthless operational playbook.
So they aren't just writing a check and walking away.
Never. They intend to sit on your board, potentially fire your underperforming executives, optimize your supply chain, and fundamentally alter the trajectory of your business.
Wow.
And they do this because their return isn't a fixed interest rate. Their return is a share of the massive new value they plan to help create.
Which creates a really intense dynamic for a founder. I mean, is he taking on private equity, basically like getting married to a incredibly wealthy, highly opinionated business partner who instantly demands a seat at your dining room table?
Well, yes, but this raises an important question about the nature of that marriage.
Oh.
Unlike an actual marriage, this partnership has a strict, legally binding expiration date built right into the prenuptial agreement.
Really?
Yeah. The fundamental reality of private equity is that the fund itself has a finite lifespan. It's usually around 10 years. From the very first day that investor sits down at your boardroom table, they are already calculating the most efficient way to exit the room.
They're planning the divorce on day one.
Exactly. They only invest because they intend to sell their stake later for a massive capital gain.
So to understand what kind of partner a company is actually getting, we have to look at exactly when the private equity firm steps into the company's timeline.
Yes.
Which brings us to the taxonomy of private equity. Our sources break this down beautifully. The industry shatters into 6 distinct operational clusters.
And these clusters map perfectly to a company's biological life cycle.
Right.
You start at the development phase, move to startup, scale into early growth, push into expansion, settle into the mature age, and finally, you potentially face crisis or decline.
The timeline is everything here. If you imagine a graph for a second, where time equals 0 is the exact moment a company is legally incorporated and officially open for business.
Okay, time 0.
The math of these deals completely shifts based on where you sit on that axis.
Yeah.
The risk profile, the expected return, the legal contracts, it all changes depending on whether the investor walks in at, month -6 or year 20.
Which is why understanding this life cycle is so crucial for 2 reasons.
Okay, what are they?
First, to see if a company can even use private equity at all. And second, to identify which kind of private equity is the right fit.
Because it's really 6 completely different businesses wearing a trench coat.
That's a great way to put it. An investor who specializes in year 20 buyouts would be utterly lost trying to navigate a month 1 startup deal. The mechanics just don't translate.
Let's rewind the clock then. Let's go back to time 0. Or actually, even before time 0.
The very first cluster.
Right, the development phase. What the industry calls seed financing.
Yeah, seed financing. And I have to stress, this is universally considered the most complex, difficult, and high-risk maneuver in the entire private equity playbook.
Really, the very first step is the hardest.
Oh, absolutely. We're talking about the conception phase. At this point, there are no customers.
No revenue.
0 revenue. In many cases, there isn't even a fully formed corporate entity yet.
Wait, if it's just an idea, what exactly are they buying?
Air. While they're buying intellectual property potential, you are financing a pure research and development project.
Right.
If it's a biotech play, you're funding scientists in a lab trying to synthesize a new molecule.
Right.
If it's tech, you're funding a couple of engineers coding a back-end architecture. The singular goal of this entire cluster isn't to build a business.
It's not.
No. It's simply to generate a patent or a functional prototype.
So you're betting on an unproven idea that hasn't even materialized into a product.
Exactly. And the binary nature of this risk is what makes it so terrifying. If the R&D fails, if the molecule doesn't bind, or the code doesn't work, the money is just gone.
Vaporized.
Completely. There are no tangible assets to liquidate. You can't sell off the office chairs to recoup a $5 million seed investment because there probably isn't an office.
But if it succeeds...
If it succeeds and they actually secure that patent, the valuation skyrockets overnight because suddenly you have a legal monopoly on a new piece of reality.
Wow. And once that patent is secured, the idea needs to become a tangible business, which pushes us across the time 0 threshold into the realm of true venture capital.
Right, moving into the second and third clusters, startup and early growth.
This is the arena most people imagine when they hear VC, right?
Yeah, this is the classic Silicon Valley image.
Because the existential question of the company fundamentally shifts here. In the seed phase, it was, can we invent this?
Right.
But now in the startup phase, the question becomes, can we manufacture this at scale, and will anyone actually pay money for it?
And here's where the concept of smart money really hits its peak intensity.
How so?
In these early clusters, the venture capitalist cannot just be a passive financier. The failure rate of early-stage startups is astronomically high. We're talking 80 to 90% failure rates.
So the VC has to practically act as a co-founder for the operational side of the business.
Exactly. The original founders might be brilliant engineers, right? But they rarely know how to set up an international supply chain or structure a complex enterprise sales team.
Or deal with aggressive corporate HR compliance.
Right. So the VC steps in to build the actual corporate machine around that raw intellectual property. They bring in seasoned executives from their network.
Because they have to. Here's where it gets really interesting for the listener. The VC relies on a few massive winners to cover the losses of all those failed startups, right?
Yes, the power law. They know out of 10 startups, 7 go to zero. 2 might return the initial cash. But that final one, the unicorn, has to succeed so spectacularly that it pays for all the massive losses and still generates a huge return for the fund.
So it's constant pressure.
Mm.
But what happens when a company actually survives that startup gauntlet? They find their market, the product works, revenues are climbing.
They enter the fourth cluster, expansion financing.
Expansion. So the company is now in its mature age, or at least the early stages of maturity.
Right. They have stable sales growth. The core business model works perfectly.
So what's the risk now? If the product works and the market exists, what are the investors worried about?
Well, the risk profile has completely flipped. It's no longer, will anyone buy this? The new risk is, can we scale this without breaking the company?
Imagine playing a video game where you've finally beaten the first level, but now you suddenly need a massive server upgrade to handle all the thousands of new players joining your guild.
That's a perfect analogy. Let's say a local brand just signed a massive contract to distribute across all of Europe.
Okay.
But they only have one factory in Ohio. To fulfill the contract, they need to build 3 new factories overseas, hire thousands of locals, and set up a global logistics network.
And the cash flow from their current sales can't possibly cover that.
Not even close. So the PE firm steps in, and their role shifts from building the foundation to injecting rocket fuel.
They provide the capital to scale, but also the heavy financial oversight to make sure the company doesn't tear itself apart while accelerating.
Exactly. Scaling too fast can bankrupt you just as quickly as having no customers.
But scaling is great if it works. Eventually, though, growth plateaus. The founders might want to step back, or early investors want to cash out.
And this brings us to the true titans of the private equity world. The 5th cluster, replacement financing.
The mega funds, the ones making headlines in the Wall Street Journal.
Yes, we are talking about leveraged buyouts, or LBOs, and private investment in public equity, which are called PIPEs.
And just to give you an idea of the scale here in the US and the UK, this cluster represents roughly 40 to 45% of the entire market.
It's massive. Let's look at the LBO first. Conceptually, the PE firm identifies a mature, somewhat sleepy company with highly predictable cash flows.
Okay.
And their goal isn't to take a 20% minority stake to help it grow. They want to buy 100% of it. Total control.
And they use a crazy amount of borrowed money to do it, which we'll dig into the exact math of later. But I want to talk about the PIPEs.
PIPEs are fascinating.
Because wait a minute, you just told the listener at the beginning of this deep dive that private equity is for non-listed companies. Now you're telling me they are playing the public stock market.
It sounds like a total contradiction, doesn't it?
Yeah.
But what's fascinating here is that the profit mechanism in a PIPE has absolutely nothing to do with daily stock exchange trading.
Okay. How does it work then?
A PE firm will negotiate directly with a public company's board to buy a massive block of newly issued shares, say 15 or 20% of the company.
Off market.
Totally off market at a negotiated price.
Right.
And because public ownership is usually fragmented among thousands of retail investors, that 20% block is often enough to give the PE firm effective voting control.
They get the swing vote.
Right. They use that control to force operational changes. And when they finally exit, they don't dump those shares back on the public exchange.
Because that would crash the stock price.
Exactly. They sell that massive block off market to a larger corporate buyer, and they demand a huge premium because that block represents control of the company.
So they use the public market to enter, but the actual strategy and the exit are done in the private shadows.
Precisely.
Unbelievable. But what if things go terribly wrong instead of right? What if the mature company is actually collapsing?
Then we hit the 6th and final cluster, the darkest one, Vulture Financing.
Right.
So the company is in crisis, severe decline.
Yes. The investment here is described in all the academic sources as very hard. The goal is to step in, revitalize underperforming divisions, or radically restructure the business to prevent total corporate failure.
It's like flipping a house that has severe termite damage and a collapsing foundation. It's dirt cheap to buy, but incredibly dangerous to try and fix.
That's very accurate. The PE firm is essentially doing triage. They might buy a failing conglomerate and immediately amputate the dying divisions to save the one profitable core software division.
Right.
And while the term vulture sounds incredibly predatory,
This financing often saves jobs and local economies from total ruin. Because without them stepping in, The entire company, including the profitable parts, would go into bankruptcy and liquidation.
They are the buyers of absolute last resort. So whether it's a fragile seed idea or a vulture triage scenario, the PE firm has to decide how involved they're going to be on a daily basis.
Yes, the operational approach. And this generally falls into two buckets, hands-on versus hands-off.
Break that down for us.
It mostly depends on whether they took a minority or majority stake and what cluster they are in. Hands-on means the PE managers operate together with the entrepreneur. They are leading and driving the company daily.
So if the company is a car, hands-on is like driver's ed. The PE firm is the instructor with their own set of brakes and a hand hovering over the steering wheel.
Exactly. Ready to jerk it back into the lane if the founder messes up. This is very common in venture capital.
And hands-off.
Hands-off is when the PE provides certification, networking, strategic knowledge, but the entrepreneur strictly drives the car.
So the instructor is just sitting in the passenger seat offering navigation tips.
Right. This is more common in certain straightforward expansion deals where the management team is already proven and world-class.
Okay, so we've mapped out the 6 clusters. We know what these deals look like. But the moment a fund actually tries to execute one of these in the real world, they hit a massive wall.
The legal reality.
Yes, because the legal universe governing these funds changes drastically depending on where you are on the globe.
We have to introduce the grand divide in global capital here. There are two fundamentally opposed regulatory philosophies. The European Union format versus the Anglo-Saxon format of the US and the UK.
Yeah, this is mind-blowing for you to consider. The exact same financial transaction is fundamentally defined differently based purely on geography.
Yes, it's an ideological difference. In Europe, private equity is viewed under the law strictly as a regulated financial service.
Okay.
But in the Anglo-Saxon world, it is viewed as an entrepreneurial activity.
Why such a stark difference?
It connects back to broader historical views on markets. The European view prioritizes systemic stability. They want central supervision over any entity moving billions of euros to prevent a broader financial collapse.
Right.
But the Anglo-Saxon view believes that market discipline, the brutal reality of losing your investors' money, is far more powerful and efficient than authority regulation.
Let's zoom in on the European framework first. How heavily guarded is this fortress?
Extremely. The EU governance relies on massive directives, the Banking Directive, the Financial Services Directive, and primarily the Alternative Investment Fund Managers Directive, the AIFM.
The AIFM.
Under this, there are basically 3 eligible entities: universal banks, investment firms, and closed-end funds. And the closed-end fund is the most relevant vehicle.
So in Europe, you literally cannot start a private equity fund without a central bank looking over your shoulder and stamping your paperwork.
You absolutely cannot. They require local central bank supervision and explicit pre-approval before you can raise a single euro. The AIFM directive forces funds to have the institutional robustness and reporting of a traditional bank.
So it improves the quote-unquote quality of the funds, but it makes it incredibly hard to start one?
Exactly. And funnily enough, this heavy EU format actually inspired the legal systems in emerging markets like Brazil, Turkey, and Russia.
Because governments like centralized control over capital.
Precisely.
Now let's contrast this heavily guarded fortress with the open plains of the Anglo-Saxon market, starting with the United States.
The U.S. is the largest PE market in the world. And it is driven by common law, meaning local and federal courts, rather than a direct central supervisor demanding pre-approval.
It's like a sports game. The U.S. system is a game where the referee, the courts, only stepped in if you actually commit a foul.
Right.
Whereas the EE system requires the referee to approve your entire team roster and playbook before the game even begins.
That's a great analogy. In the U.S., the dominant vehicle is the limited partnership, usually for venture capital funds.
And how does the SEC regulate them?
The SEC regulates the relevant financial activities, not the institutions themselves. As long as a fund only takes money from accredited investors, meaning highly sophisticated or wealthy entities, the SEC largely lets them structure their partnerships however they want.
And that lack of a central supervisor allows for rapid innovation in fund structures, which is why the U.S. absolutely dominates VC.
Yes. They also use SBICs, which are small business investment companies.
What are those?
It's a fascinating form of public-private partnership where the U.S. government provides leverage to private funds to stimulate investment in local small businesses.
Yeah. But the U.S. doesn't hold the Anglo-Saxon title alone. We have to cross the pond to where private equity was essentially born, the
Right.
U.K.
Right. The UK framework is similar to the US in that it lacks overarching master laws regulating the whole financial system for PE.
So what do they use?
It operates on a mix of ad hoc laws and, very importantly, specific tax regulations. The entities there include standard venture capital funds, banks, business angels, and venture capital trusts, or VCTs.
Wait, why do tax regulations act as the primary law there?
Because the UK government uses tax incentives to guide capital.
Like a carrot instead of a stick.
Exactly. With a VCT, if a wealthy individual invests in risky startups through this trust, the government gives them massive upfront income tax relief, and the capital gains are tax-free.
Oh, wow.
Yeah, so instead of mandating investment through heavy-handed directives, they just make it incredibly mathematically attractive to fund startups.
Brilliant. So despite these massive legal differences globally, whether you're dealing with central banks in Frankfurt, SEC rules in California, or tax trusts in London, the day-to-day reality of running a fund is surprisingly universal.
Yes. Once the legal entity is set up, we enter the engine room, the managerial process.
And to understand the engine room, we have to introduce the two main players behind any legal entity, the GPs and the LPs.
The general partners or managers and the limited partners, the investors.
Right. Regardless of where you are in the world, the day-to-day activity of a managerial process is identical, and it consists of four distinct phases.
Fundraising, investing, managing and monitoring, and exiting.
This is the actual blueprint for how Wall Street titans spend their week.
And if we connect this to the bigger picture, the reason this strict four-step process exists is specifically because of that structural separation.
Between the GPs and LPs.
Exactly. The people who manage the money, the GPs, do not supply the money, the LPs do, so they need this rigid framework to govern the trust between them.
And everything starts with phase one.
Yeah.
Which ironically happens before the clock even officially starts ticking.
Yes. Phase one is fundraising. This happens before time zero of the fund's official life. The asset management company, the GPs, must go out and convince investors to lock up their capital.
And I understand this is extremely difficult.
Oh, it's brutal. For example, in a European closed-end fund, managers typically only have about 1.5 years to gather all the money.
18 months.
Yeah. And investors are committing their capital for a very long time, often a full 10 years. It's a blind pool. They don't know what companies the GP will buy.
So what does this all mean for the listener? It means the managers are basically selling a promise.
Yes.
They are pointing to their past track record, asking for hundreds of millions of dollars from pension funds, and telling those investors, you cannot have this back for a decade.
The trust required is immense. Pension funds, insurers, high net worth individuals, they commit this capital simply hoping that the manager's exclusive deal flow will generate returns higher than the public stock market.
But once that war chest is full, the hunt begins. Welcome to phase two.
Phase two is investing. This is the decision and deal-making phase.
And here's where we get into the crazy math of the leveraged buyout that we mentioned earlier, the actual mechanics of an LBO.
Right. Let's look at the SPV mechanism, the special purpose vehicle.
Let's walk the listener through this math visually because it's kind of unbelievable.
Okay, let's say a PE firm identifies a target company to buy for $100 million.
Right. They want to buy 100% of it.
Well, they don't use $100 million of their own fund's money. First, they create an SPV, a brand new empty shell company. The PE firm owns 100% of this shell.
Okay, an empty legal bucket.
Yes. Then they put a small fraction of their fund's cash into the SPV. Let's say $10 million in equity.
So they still need $90 million.
Right. So they take this SPV to a syndicate of banks and borrow the remaining $90 million.
Wait, a bank loans $90 million to an empty shell company?
They do because the collateral for the loan is the assets of the target company they are about to buy.
Oh, wow. So you want to buy a $100 million company. You only use $10 million of your fund's money, borrow $90 million through a shell company, buy the target, and then what?
Immediately after the purchase, they merge the SPV into the target company. The shell disappears, but the debt stays.
So the target company is now saddled with a $90 million loan that it has to pay off using its own revenues.
Exactly. It's the ultimate financial leverage. The PE firm controls a $100 million asset, but only put $10 million at risk. And often they even use syndication, where they split that 10 million equity check with other PE firms to dilute their exposure even further.
That is wild. But what's the risk?
The risk is total collapse. If the target company has a bad quarter and doesn't generate enough cash to pay the monthly interest on that massive 90 million debt,
The banks foreclose.
the banks foreclose. The entire SPV collapses, the company goes bankrupt, and the PE firm's 10 million equity goes to absolute zero instantly.
Which is exactly why, if the deal is successful and they acquire the company, they can't just relax. They have to transition immediately to phase 3 to make sure the company doesn't default.
Phase 3 is managing and monitoring, value creation and value protection.
The phase. The PE firm obviously has to support the company to generate more value, to grow the revenue so they can pay down that debt.
Right.
But equally important, they must protect the value they've already created.
And we have to remind everyone of the core problem here. Private equity investments are utterly illiquid.
You can't just sell the stock on an app if you get nervous.
No. There's a huge problem of pricing and liquidity. You are trapped in the investment. So managing and monitoring is really about creating the absolute perfect conditions for a future exit.
It's like buying a incredibly rare vintage car to flip at an auction.
Okay.
You don't just park it in the driveway. You have to actively tune the engine and fix the interior that's value creation.
Right.
But you also need to build a highly secure, climate-controlled garage with an alarm system so nobody steals it or damages it before the auction day. That's value protection.
Building that secure garage relies entirely on a complex web of legal agreements called covenants.
The structural seatbelts of the private equity vehicle.
Exactly. There are 9 crucial covenants we need to look at, usually grouped into 3 parts. Let's look at the first 3, which are designed entirely to lock the entrepreneur into the business.
Covenants. Part 1. Securing the entrepreneur. We're talking about lockup, permitted transfer, and staging. Break these down.
First is the lockup. This literally prevents a shareholder, usually the founder, from selling their shares before a certain predefined time.
This sounds so paranoid.
Well, think about it in a startup context.
Wow.
The PE firm invests $20 million because they believe in the founder's genius. If there's no lockup, the founder could take the newly inflated valuation, sell their shares to a random buyer, and immediately run to a beach in the Bahamas.
Ah. The PE firm invests in you because they believe in you, but their first legal move is tying you to the radiator so you can't leave.
I wouldn't phrase it quite like that, but yes, they are investing in the human capital of the entrepreneur. If the founder leaves, the value of the startup essentially goes to zero.
Okay, what about permitted transfer?
This means a shareholder can only sell their shares with the explicit approval of the other shareholder. The PE firm gets veto power over who is allowed onto the cap table.
And staging.
Staging is a technique heavily popular in U.S. startups. The capital isn't handed over in one giant check. It's released in tranches, or stages, based purely on performance milestones.
So we'll give you $2 million now, and if you finish the prototype by August, we'll give you the next $3 million.
Exactly. It keeps the entrepreneur incredibly hungry and focused.
But what if the relationship sours? Or what if an amazing acquisition offer comes along, but the partners disagree on whether to sell?
We need legal mechanisms for parting ways. This is Covenants Part 2, Options and Tag Drag Rights.
Let's start with the options, puttable and callable securities.
These are shares with embedded options. If a PE firm holds puttable shares, they can legally force the founder to buy them out at a set price.
So they can force an exit if they want out.
Right. And callable shares are the opposite. The founder can forcibly buy out the PE firm, effectively firing them, though obviously the founder needs deep liquidity to actually do that.
Right. Now let's talk about the tag and drag rights, because this is where the power dynamics get really aggressive.
Tag-along rights are defensive. If a minority PE investor has tag-along rights and the majority entrepreneur decides to sell their stake to a third party, the PE firm can tag along. They can force the buyer to purchase their minority stake at the exact same price.
So they don't get left behind with a new majority owner they didn't approve of.
Exactly. But the ultimate power move, the absolute trump card in private equity, is the drag-along right.
Drag-along right.
If the PE firm holds drag-along rights, they can legally force all other shareholders to sell their stakes during an exit event.
Wait, so the PE firm could own, just say, 51% of the company.
Yes.
And they find a buyer. They can legally force the founder, who owns 49% and might not want to sell their life's work, to sell against their will, just to make the deal sweeter for the buyer.
Yes, they drag them to the closing table. And the economic necessity here is that corporate buyers often flat out refuse to buy a company unless they can get 100% total control.
They want a clean slate.
Right. Without the drag-along covenant, a founder with a minority stake could stubbornly block a billion-dollar exit. The PE firm cannot allow that risk.
Ruthless.
Yeah.
Okay, the final two covenants deal with protecting the pure financial upside of the deal. Covenants Part 3.
Right of first refusal and the exit ratchet.
Let's hit right of first refusal.
If the founder wants to sell shares to an outsider, the PE firm has the legal right to match that price and buy those shares first. It protects their portfolio concentration and keeps outsiders away.
And the exit ratchet.
This is a really elegant mechanism. It's an agreement where a percentage of the capital gain is shifted back to one of the shareholders upon exit based on performance.
So if a founder builds a spectacularly successful company that sells for triple the expected price, the ratchet triggers and rewards them with an extra bonus slice of the pie.
Exactly. Or it can reward the PE firm if they had to go above and beyond in their operational support. It mathematically aligns incentives.
So when you look at all of this, the lockups, the staged capital, the drag-along rights, I mean, behind every friendly handshake deal we read about in tech blogs, there is a incredibly dense term sheet operating like a complex game of 3D chess.
It is entirely 3D chess, but you have to remember, these covenants are just the setup. They are purely defensive. The end game for playing all this chess is to finally arrive at phase 4, exiting.
Right, the exit strategy. Because how does the PE firm finally get their cash back out of this illiquid company?
The fund has a lifespan. The clock is ticking. They absolutely must exit to generate a realized capital gain for their LPs.
And there are a few avenues for this, right?
Yes, they could invoke the puttable shares, making the entrepreneur buy them out, but that assumes the founder has massive cash on hand.
Rare.
Very rare. So the two main paths are selling the company to another corporation, which is called a trade sale, or the Holy Grail, the IPO, the initial public offering.
And I want to highlight a staggering statistic from the source material here. The IPO, the exit that gets literally all the media attention, the ringing of the bell, it only happens in about 1% of cases.
1%. It is a total statistical anomaly.
Why? Why is it so rare when it's all we hear about?
Because IPOs are incredibly expensive, highly regulated, and they require massive public market appetite. You are at the mercy of macroeconomic trends. If the market dips the week of your IPO, the whole deal collapses.
So what do they do instead?
The trade sale.
Yeah.
Selling the company privately to a larger competitor is far more common, far cheaper, and vastly more reliable.
But before you can sell, whether it's an IPO or a trade sale, you have to know what the company's actually worth.
Valuation.
Which brings us to the final piece of the puzzle. Section 21, crunching the numbers. Company valuation.
Valuing a private company is a dark art. To determine the equity split, the industry relies primarily on two methods: the traditional discounted cash flow method, the DCF, and the highly specific venture capital method.
Let's start with DCF. This is standard Wall Street math.
Right. The core concept of DCF is projecting all the future free cash flows a company will ever produce, and then discounting them back to today's value to find the enterprise value.
And they discount it using a metric called the weighted average cost of capital, the WACC.
Yes. WACC blends the cost of the company's debt with the expected return demanded by equity investors.
But wait, if you're a startup and your equity investors are demanding massive venture-level returns, your WACC is going to be incredibly high.
Sky high. And if you discount future cash flows by a massive WACC, the present valuation completely tanks.
Not to mention, startups usually have negative cash flows for the first 5 years anyway.
Exactly. If you plug a startup's negative cash flows into a traditional DCF model, the spreadsheet will literally tell you the company is worth less than zero.
Which means the VC firms had to invent their own math to justify these deals.
Yes, the venture capital method. And it is entirely different from DCF. The VC method works backward.
Break this math down for the listeners so it really clicks. How does working backward actually function?
Okay, you know the number of existing shares the founder has today. Let's say 100,000 shares.
Okay, 100,000 shares.
You don't try to value the company today. Instead, you estimate the future terminal value of the investment. You say, in 5 years, we believe we can sell this company for $50 million.
Based on industry comparables or whatnot.
Then, the VC firm decides exactly what percentage of that future $50 million they need to own to satisfy their own fund's return requirements.
So they say, we absolutely must own 20% of this company at the exit.
Exactly. So you have the future value, the desired percentage, and the current share count. The VC method uses those inputs to calculate the exact number of new shares that must be issued today to arrive at a precise price per share.
So they don't just guess a price today. They say, we want 20% of the company at the end, so we will print exactly enough new shares today at, say, 20.53 euros per share to make that math perfectly aligned years from now.
That is exactly right. You are reverse engineering your desired future return into today's term sheet.
It's incredible. Valuation in private markets is less about discovering some intrinsic truth about the company's current worth and way more about backward-engineered financial goals mixed with just intense, hard-nosed negotiation.
That's the perfect summary. The math serves the structure of the deal.
Well, we have covered an immense amount of ground today.
We really have.
Let's quickly recap this journey for everyone listening. We started with the basic definition PE as both a financing lifeline and a high-stakes investment. We traversed the 6 distinct clusters, from seed to vulture.
We navigated the global legal divide between the EU fortress and the Anglo-Saxon open plains.
We broke down the engine room, the GPs, the LPs, and the 4 managerial steps. We survived the incredibly strict legal covenants, found the exit strategy, and finally crunched the reverse-engineered valuation math.
It's a massive, highly orchestrated machine. And, there's a final thought I want to leave everyone with on this.
What's that?
We've spent this entire deep dive looking at how private equity and venture capital firms tightly control, ruthlessly monitor, and eventually exit the companies they buy.
Right.
But as more and more global capital flows permanently away from public stock markets and pours into these private, heavily shielded funds, we have to ask a bigger macroeconomic question.
Okay.
What happens to the global economy when the most innovative, highest growth companies remain entirely locked behind closed doors, accessible only to the wealthy LPs who hold the keys?
Wow. That is the perfect provocative thought to leave you with today, when the wealth generation of the future happens entirely off-market. Thank you so much for joining us in the engine room for this deep dive into the financial machinery running our world. Keep questioning the systems you see, and more importantly, keep questioning the mechanics of the systems you don't.